So today, folks, we're going to have an interview. We have Mr. Adam Gant, the CEO of Partners REIT. If we look at Partners REIT, that's an open real estate investment trust. Actually, Partners REIT performed pretty well, technically speaking. It's a company that pays a dividend. It's keeping its upward trend. So Mr. Gant is with us today. I don't know if we have him on the line.
Hi, good day.
Hi, hello, Mr. Gant.
How are you doing?
I'm doing good, thank you. So, Mr. Gant, just want to know something. Ever since you took over the company, what changes have you bring to the growth strategy of your company? Can you highlight some of the changes that you have bring?
Yeah, a number of very significant changes, in fact. It's been just over 2 years now, and we had a number of key areas that we put a lot of time and effort into to set the company up with a much stronger base, both with access to financing with lines of credit for acquisitions, with improved first mortgages and reducing the costs. I think most importantly, we expanded the management team and brought in some very strong executive members who have a long background with retail shopping center real estate, able to source new acquisition opportunities and to continue to improve the value of the properties that we already own and grow the portfolio.
Okay, excellent. So actually, with this new addition to the management and to the people that you bring to the team, do you intend to be more aggressive or less aggressive? Because how do you find the financing conditions so far for the commercial real estate? Do you find them to be overvalued, or you tend to be more prudent in your acquisitions for the next year?
Well, I think we saw a lot of activity in the springtime of this year that pushed the returns down, or there was enough demand that it dropped the cap rates down throughout the springtime. And I think we've seen them stabilize again this fall. I know that a lot of the life insurance companies put out their debt financing in the springtime, and it tends to improve liquidity initially in the year. And we saw the same thing happen last year, where cap rates moved down in the beginning of the year and then stabilized in the fall. There's been a number of REITs that have raised a lot of capital in the fall. So I think there are a number of REITs out there that can go and make acquisitions, but we're just not seeing as much deal activity now as we did back in the springtime or in the late spring. So going forward, we certainly have been aggressive in terms of putting out offers to acquire new assets, but at prices that we felt comfortable with based on the quality of that asset. So now going forward, we're looking at acquiring, continually improving quality in the properties that we're buying, but trying to keep it in the range of the returns that we've been seeing over the last year.
Okay.
But that has tightened up.
Okay, excellent. So in terms of the acquisitions, is there a particular, because I know you are throughout Canada, mostly in Ontario province, but is there a particular province right now where you want to expand, where you see some pockets of growth?
Well, we still really like what we see in and around Montreal and the province of Quebec.
Okay.
We've acquired a number of properties there and really do like what we see in and around Montreal. We're also looking out west now even more. One of the things that we've done that's a little bit different than some of the other REITs is made a real effort to align ourselves with third-party developers who are creating new shopping centers.
Okay.
And we've got a very large development partner that we are working with out in the province of BC. We also have one that we're looking to start working with further in around Montreal, and two smaller developers in the province of Ontario. So really, I think in the future, we're going to add a handful of additional development partnership relationships, which give us access to brand new properties. And then also, we're going to start to push more into BC and Alberta and acquire more assets out west to further diversify the portfolio and balance out the allocation by province.
Okay, excellent. So with all those plans that you have to acquire by partnering with other people, do you think that, of course, that this is going to require some debt, some cash flow to be able to finance those acquisitions? So actually, do you intend to either increase your distribution rate or to keep it at a rate of 8%, or what are you going to do about this, about your distribution? Is it going to be the same for...
So our goal with our distribution is certainly to increase the amount of income that we're generating over time, and to then be able to increase the distribution. And we'll look at it every year. And I think people won't be surprised when we do increase the distribution, because we'll increase the distribution after we've achieved an increase in underlying income from the properties. And how we'll do that is certainly, where we're focusing on new leases and adding income from increased rental rates, but also acquiring properties that are accretive to the REIT that add additional income per unit.
Okay.
And the more that we acquire the higher quality assets and really see the yield compression take effect on our unit value over time, that the more that we'll be able to increase the size of the REIT and ideally also the amount of income that we're generating.
And in terms of yield, I have two questions for you right now. In terms of yield, because I know your company recently has been able to rank among the top 5 highest real yield REITs in Canada. So first of all, what's the recipe behind the success? How you intend to maintain your company within that rank? And also, talking about the fact that you said you want to acquire quality assets, how do you find the commercial real estate market for shopping centers? Is it really, you find the best assets to be really heavily concentrated within some few players, or how is it?
No, those are great questions. So maybe just breaking it apart, in terms of the yield and how we've got to this top 5 spot, I think it's really mainly because of our relative age. So because it is a new REIT, two things happen. One is we've built it so quickly that it is undervalued today, or on the in terms of what you have to pay per unit. You're buying the units for less than you would have to buy elsewhere, and therefore you're getting a higher income stream than you would with other larger REITs in existence that have been around for a lot longer.
Okay.
The other aspect that takes effect is that because we're younger, we have more depreciation allowance that we can take, so more of our income is considered return of capital. So you're actually getting to keep more of the yield that we pay out on an after-tax basis every year because we've got more depreciation because we're new. So that alone is a pretty powerful component of the return, because 100% of the distribution is considered return of capital and therefore not taxable as income in that calendar year. So those key factors are at play, and then as we grow, of course, we'll continue to replenish that amount of depreciation that we can use and allow us to continue to have very good after-tax returns. But I think it's just because we're new that you see that higher yield. As people start to get to know us more and see what we're doing, and the unit value continues to grow, that yield will obviously then become more in line with some of the other the REITs that are out there, which will obviously have created a good return along the way for anybody that's already a unit holder. And then I think to your other question on where are we seeing good opportunities?
No, I mean, it's mostly like about the commercial real estate, like, because you say you want to acquire quality assets, but I'm wondering like about the commercial market. Is it like mostly the good assets or mostly concentrated within a few companies? Because I remember I saw an interview of another real estate company which has been there for a while, and they were saying that actually the market seems to be really concentrated. They were shopping mostly in the U.S. right now. So what's your take on this? Is it really the case, or?
Yeah, no, I think those are some good points. There are the biggest REITs in Canada today are retail shopping center REITs. So to me, that points to some good evidence that there is lots of room for us to grow. However, to make sure that we can get the best quality properties or the best properties that are out there, we have to have, I think, a competitive advantage with that. And that's exactly where our partners REIT strategy comes from. Because any of the new properties that get built or developed, or any of the best properties that are out there in the market, typically the bigger REITs that have the best cost of capital can acquire them, and once they acquire them, they'll never let them go because those would be the best properties in their portfolio. So for us to get there and to get our hands on those, we really have to be there before the other bigger REITs. And to do that, we have to have lots of development partners creating lots of new properties, and to have some position with them that keeps us first in line to buy those once complete. And I think for developers, there's a couple things that matter to them. One is help getting debt financing or sourcing financing so we can use our relationships to help them get the best financing available. The other aspect of it is what developers want to see is they want to turn their capital over and to be able to go and buy and develop more assets. So being there to buy it once complete and managing the timing of that is important to them. And REITs also present tax planning advantages for sellers, and that also is a feature that some developers can use. So those factors help us work with developers and make sure that we get to acquire brand new properties with fresh long-term leases right as they are completed.
Okay, excellent. So really the partnering with the developers is really a key in your growth strategy, right? Developing this relationship.
Absolutely.
Okay. Excellent.
Yeah, absolutely.
So one thing, Mr. Gant, to finish the interview, because our viewers are looking at your company, technically speaking, yes, the company is performing pretty well when you look at the graph, but for an investor who really doesn't know much about REITs in general, why should he consider your company as a potential buy instead of another company?
So I think three key reasons, really.
Three, okay.
One is we are a growth story,
okay.
And we'll grow faster as a percentage of our existing base than a lot of the other existing REITs that are out there. We are still young and still have a high level of tax efficiency, or what I like to call tax efficiency. So more of the income that's paid out is deferred by depreciation.
Okay.
And then lastly, we also have a good value. We've acquired and we're continuing to acquire assets that have very stable income,
okay.
Food-anchored, drugstore-anchored shopping centers that are necessity-based retail, where customers will go to these properties every day of the week, regardless of how well the business and the economy, business cycle and the economy are doing.
Yeah.
And that constant traffic keeps the occupancy high and the income stream stable.
Yeah.
So those factors to me are the reason why we are an attractive REIT, and at the value and the price that it's trading at right now with the yield that's being paid out, I think it makes a lot of sense for people to own us today.
Okay, excellent. So Adam, thank you for coming by phone. We look forward to receive you in our studios eventually, and about a couple of weeks if ever there's some major developments in your company.
That sounds great. Thank you very much, Chris.
Thank you, Adam.
Okay, bye for now.
Bye.